Hello students, greetings of the day. St. Joseph's College for Women Autonomous Vishakhapatnam welcomes to St. Joseph's open web-based learning platform. So e-learn for a soulful and enriching e-learning experience. Department of Commerce and Management of St. Joseph's College for Women Autonomous presents MOOC, St. Joseph's massive open online course. I am R. Pavani, Assistant Professor, Department of Commerce and Management of St. Joseph's College for Women, Autonomous Vishakhapatnam. Would like to teach you third module, Accounting Principles in Introduction of Commerce. The second submodule of Accounting Principles module is Branches of Accounting. So students, the outcome of this chapter is to understand the concept of accounting cycle, to explain the rules of accounting, to analyze the uses of accounting, to interpret the basic terminology in accounting. The contents of this second submodule are accounting cycle, users of accounting, branches of accounting, basic accounting terminology. So students, first of all, we will discuss about accounting cycle. The accounting cycle is a series of steps followed by an organization to identify, analyze, and record of its financial transactions. The accounting cycle starts with the identification of transaction and ends with creation of financial statements. The key steps in the accounting cycle are Step 1, identify transactions. Step 2, record journal entries. Step 3, post journal transactions or in ledger. Step 4, calculate unadjusted trial balance. Step 5, analyze the worksheet and identify the errors. Step 6, fix journals and prepare the adjusted trial balance. Step 7, create financial statements. Step 8, close the books. The first step involves identifying and analyzing financial transactions. Not all transactions are recorded, only those that pertain to the business and can be measured in monetary terms are considered. Only the monetary value transactions will be identified and recorded in the books of accounts. Non-monetary transactions should not be recorded in the books of accounts. Step 2 is recording of journal entries. Once identify the transactions, it should be recorded in the books of journal in a chronological order. Means date-wise you have to record in the books of journal. This process will be called as journalizing. Each entry includes date, accounts affected, amounts, and with a brief description that is called narration. After journal, the next step is posting the journal into the relevant ledgers. The ledger is a collection of accounts which similar transactions are grouped together. This helps in categorization of transactions and maintaining accounting balances. After posting the ledger, a trial balance will be prepared to ensure the debits are equivalent to credits or not. The trial balance is a list of all ledger accounts and their balances at a particular time. It helps in identifying and discrepancies or errors in the recording process. After preparation of a trial balance, if it is not tallied, we have to adjust the entries which are made the account for accrued and deferred items. Adjustment entries ensures that revenues and expenses are recognized in the period they occur, following with the matching principles. An adjusted trial balance will be prepared after adjusting the entries are made. It includes all the adjustments and provides a basis for preparing financial statements. After adjustment of a trial balance, it is used to prepare final accounts that will be called as financial statements. It includes profit and loss account, balance sheet, cash flow statement. After preparation of financial statements, the last step in the accounting cycle is to close the books. Transfer the balances to the temporary accounts, either revenues, expenses, or dividends, or to the permanent accounts, to profit and loss account. This resets the balances of temporary accounts to zero for the next accounting period. So the process will continue. Now we are going to discuss about users of accounting information. We have two types of users who wants to know about accounting information of the concern, but internal users and external users. Management, employees, shareholders are internal users. The remaining all are external users. Investors wants to know about the financial information because if they want to get a timely dividends or not. Creditors wants to know about the financial information because they concerned about liquidity and timely payments of their amount. Proprietors want to know about the financial information because either their business concern is earning profits or not. If the business concern is earning a profits, then it will be helpful for the future expansion of a business. Employees want to know about the financial information because of their job security and as well as they will get bonus. And customers also interested in the financial information of a business because they want a product warranties and as well as price regulation. And government uses for tax purposes and monitoring regulatory compliance may assess economic impact of the businesses. And researchers want to know about the financial information because if they want to develop a new product, this information is very helpful. Now we are going to discuss about rules of accounting. Accounting is governed by a set of rules that dictate how financial transactions should be recorded and reported. These rules ensures consistency, accuracy, and reliability in financial reporting. The primary rules of accounting are personal account rule, debit the receiver, credit the giver. When a person or entity receives something, the account is debited. When a person or entity gives something, that account should be credited. Personal accounts means Ram account, Sita account, Geeta account, all these are called as personal account. Purchased goods from Ram. Ram is giving the goods. So Ram is credit. Real account. Debit what comes in, credit what goes out. When an asset or resource comes into the business, it should be debited. When an asset or resource goes out, it should be credited. For example, machinery purchased for cash. Machinery is coming, cash is going. So machinery should be debit and cash should be credit. Then nominal account. Debit all expenses and losses, credit all incomes and gains. Expenses and losses are debited because they decrease equity, while incomes and gains are credited because they increase equity. For example, paid salaries. Salaries are expenses, so it should be debit. Received interest. Interest is income, so it should be credit. These are the golden rules of accounting or fundamental principles that guide the recording of transactions in the books of accounts. These rules are categorized based on the types of accounts. These accounts are personal account, real account, and nominal account. Accounting is a diverse field that encompasses various branches, each focusing on different aspects of financial management and reporting. These branches cater to the specific needs of different stakeholders from internal management and employees to external parties like investors, creditors, and regulatory agencies. Each branch of accounting has its own set of principles, practices, and objectives tailored to its purpose. The main branches of accounting are financial accounting, cost accounting, management accounting. Now, financial accounting is a branch of accounting that focuses on the preparation and reporting of financial statements for external stakeholders such as investors, creditors, regulators, and the public. It involves recording, summarizing, and communicating a company's financial information in accordance with established accounting standards and regulations. Financial accounting helps to communicate the results to its users, and it shows the profit or loss of a particular period and the position of the business on a particular date. The components of financial accounting is financial statements, that is profit and loss account and balance sheet, and auditing and assurance, which are external audits by certified public accountants, ensure the fairness and accuracy of financial statements. The importance of financial accounting is it provides investors with reliable and transparent information for investment decisions and also assures creditors of the company's ability to repay debts and manage financial obligations, and also ensures compliance with legal and regulatory requirements for financial reporting and disclosure. Cost accounting is another branch of accounting that focuses on the accurate tracking, analysis, and management of costs associated with producing goods or providing services. Its primary aim is to assist businesses in control and reducing costs, improving profitability, and making informed financial decisions. The main objective of cost accounting is cost control, cost reduction. And we have a different types of costs in the cost accounting. Those are fixed costs, variable costs, and semi-variable costs. Management accounting is type of accounting branch focused on helping managers make decisions within an organization. It provides information about costs, budgets, and performance to assist with planning and control operations. Unlike financial accounting, which is aimed at external audience like investors and follows strict rules, management accounting is flexible and tailored to the needs of a company. The main goal of management accounting is to support business decision making. It helps managers to understand how the business is performing and where improvements can be made by analyzing data. And the objective of management accounting is planning, controlling, and decision making. So, students, understanding basic accounting terminologies is essential for financial statements and for the overall accounting process. The following are some accounting terms and their meanings we will discuss now. First one is capital. Capital means it's a owner's residual interest in the assets of the business after deducting liability. It is also called as shareholders' equity. Example, the invested money by the owner is called as capital. The next term is assets. Resources owned by the business that have economic value and can provide future benefits are called as assets. Cash, inventory, buildings, plant and machinery, equipment, all these are examples of assets. The next term is liabilities. Obligations or debts that a business owes to external parties and must be settled in the future. That is called liabilities. Examples are mortgages, loans, overdrafts, bills payable. The next term is expenses. The costs incurred in the process of earning revenue are called as expenses. Example, rent, salaries, transportation, insurance payment, etc. The next term is income. The income earned from the sale of goods or services before any expenses are deducted. Example, sales or any interest received or rent received, dividend received. The next term is debit. All the receiving benefit is debit. Credit. All the paying benefit is credit. Profit. The financial gain realized when total revenues exceeded total expenses are called as profit. Loss. The financial results when total expenses are more than total revenues is called loss. Depreciation. The systematic allocation of the cost of a tangible fixed assets over its useful life is called as depreciation. So students, check your progress. Every businessman must follow the rules to enter a business transactions in the books of accounting. He will follow the double entry system of bookkeeping. Debit the receiver, credit the giver for personal account. Debit what comes in and credit what goes out for real account. Debit all expenses and losses and credit all incomes and gains for nominal account. These are the rules which have to follow by every businessman to enter business transactions in the books of accounting. So your activity is visit two small business organizations and meet their accountants and senior accounts officers and identify their accounts maintaining activities. Thank you students. Happy learning.